Lesson 1. What quantitative trading actually is, and why Freqtrade. Let me start with a scene you probably recognize. Summoner wakes up, checks the price of Bitcoin, and it is down 5%. They feel a little sick. A friend messages to say it is definitely going to bounce back. So they buy. 2 hours later it is up 2%, and now they can't decide whether to sell. They don't. By the afternoon it is dropped again. Now they're annoyed at themselves for not selling. By evening they can't take it anymore, so they cut the loss at -3% and go to bed. And then, of course, the next morning Bitcoin jumps 10%. That is how most people trade. It is emotional, it is exhausting, and the hours are brutal, because crypto never closes. You are making decisions when you are tired, when you are scared, when you are greedy, and mostly by feel. Luck plays a bigger role than anyone wants to admit, and the pattern is almost always the same. Buy high, sell low, regret it. Quantitative trading is the alternative, and the simplest way I can describe it is this. Instead of you deciding when to buy and sell in the moment, you write down a set of rules in advance. And a program follows those rules for you without emotion, without sleeping, without getting bored. So a trading bot's day looks completely different. It just loops. Every few minutes it pulls the current price. It checks whatever conditions you defined, and if those conditions are met it places the order. If profit hits your target it sells. If the loss hits your limit it sells. It doesn't hesitate because hesitation isn't in the code. So what is quantitative trading? Really, if you strip away the buzzwords, it comes down to 3 things: a strategy, some data, and a way to execute automatically. The strategy is the answer to 2 questions. When do I buy and when do I sell? That is it. A simple one might be, buy when the 20-day moving average crosses above the 50-day, and sell when it crosses back below. You can make strategies far more complicated than that, but at heart, they're all just rules. The data is the history. Prices, volumes, indicators computed from those prices. You need this because you want to test your rules against what actually happened before you trust them with real money. And execution is the part that runs on its own. The program watches the market, places orders, sets stop losses, takes profits. You are not clicking buttons at 3 a.m. The whole point is that you are not involved in the moment-to-moment decisions. Here is a concrete example, so this isn't abstract. Imagine a strategy that says, every day, check whether Bitcoin's 20-day average just crossed above its 50-day average. If it did, buy $100 worth. If it crossed below, sell. That is the entire logic. Now, you could just try that with real money and hope. Or you could backtest it, which means feeding in a year of historical prices and simulating what would have happened. Let's say you run it over all of 2024. Starting with $10,000 and the simulation says you'd have ended with $12,500. That is a 25% return with a 65% win rate on individual trades. That sounds great. And it might genuinely be a reasonable strategy. But here is the honest part, and I want you to hold on to it for the whole course. A strategy that worked in 2024 does not owe you anything in 2025. The backtest tells you what happened. It does not tell you what will happen. Why people bother with this? Let me give you the real advantages, not the sales pitch. The big one is that it removes you from the decision. Think about panic selling. Bitcoin drops 10%. A manual trader panics and sells, and then it recovers the next day and they're furious. A bot doesn't panic. It checks whether its sell conditions are met. If they're not, it holds. The discipline is mechanical. Then there is the hours. Crypto trades 24 hours a day. 7 days a week, all over the world. Some of the best moves happen at 3 in the morning, your local time. You are not going to catch those by staring at a screen. A bot will. You sleep through it and wake up to find it bought on a signal, and you are up 3%. Speed matters too. A human might take a minute or 2 to notice a signal, and another 30 seconds to place an order. A bot does it in under a second. In fast markets, that difference is real money. And a bot can watch dozens of trading pairs at the same time. You genuinely cannot. No one can monitor 50 coins by hand. The fourth advantage is that it is data-driven rather than gut-driven. Instead of, I think this coin is going up, or, my friend said it is reliable. You are working from something you can actually measure. You backtested 1,000 historical trades. You know the win rate was 70%. You know the average profit per trade. That is a completely different basis for a decision. And the last one, which is what this whole course is really about, is that you can test and improve. With manual trading, the only way to find out if an idea works is to risk real money on it. With quant trading, you test on historical data for free, find the problems, tweak the parameters, test again. You only put real money in once something has earned it. The honest part, the risks, this is where I want to slow down, because anyone selling you on quant trading without telling you the risks is lying to you. The first risk is called overfitting, and it is the one that catches everyone. Here is an extreme version so you can see it clearly. Imagine a strategy that says, if the date is the 15th of March 2024 and the time is 14:23, buy Bitcoin. If it is the 16th of March at 9:47, sell. Run that through a backtest and it looks perfect. You caught a historic surge. The backtest result is beautiful. And then you run it live and it does absolutely nothing, because that exact moment is never coming back. That is overfitting. You fit your rules so tightly to the past that they only describe the past. The real strategies that fail this way aren't usually this obvious, but the disease is the same. You tune and tune until the backtest looks amazing, and then it falls apart the moment it meets the real market. How do you avoid it? Don't optimize obsessively. Keep your logic simple. Test your strategy across different time periods, not just the one where it happened to shine. Always hold back some data the strategy has never seen and test on that, and use enough history. A month is not enough. You want at least a year, ideally more. The second risk is technical. Bots run on servers, and servers have problems. Your network drops and you miss a trade. The program crashes and a stop loss doesn't fire while the loss keeps growing. You hit an exchange's rate limit and suddenly you can't place orders at all. Bad price data reaches your bot, and it buys at exactly the wrong moment. These things happen. You deal with them by running on a stable server, setting up monitoring, keeping a backup exchange, and always having a maximum loss the system will respect. The third risk is that markets change. A strategy that prints money in a choppy, sideways market can bleed money in a trending bull market, because the conditions it was built for no longer exist. The market doesn't care that your backtest was great, so you have to keep watching performance, keep retesting, and ideally have more than one strategy for more than one kind of market. The fourth is black swans, the truly extreme events that almost never show up in your historical data, which means your backtest never prepared you for them. Bitcoin dropped 50% in a single day in March 2020. Terror. The Luna token went from $80 to essentially zero in 2022. Exchanges have gone bankrupt and taken customer funds with them. No backtest predicts these. Your only defense is hard stop losses, real diversification, and never putting in money you can't afford to watch disappear. And the fifth risk is psychological, and I think people underestimate this one. Even with a bot doing the trading, the psychology doesn't go away, it just moves. Your backtest said plus 50% over a year. You go live and the first month is minus 5%. The temptation to rip the whole thing out is enormous. A lot of people can't resist fiddling with the strategy every week, chasing perfection, or shutting it down the moment they see red, or pumping in more money after a win, because greed takes over, or overriding the bot manually, because they don't trust it. Every one of those is a way to sabotage yourself. The fix is mostly temperament. Have a plan, stick to it. Write down what you did and why, and give a strategy enough time, months not days, before you judge it. Where Freqtrade fits in, so that is the landscape. Now, what is Freqtrade specifically? Freqtrade is a free, open-source trading bot written in Python. It has been around since 2017. It has thousands of developers starring it on GitHub, and it handles the whole loop. You write strategies, you backtest them against historical data, you optimize parameters, you paper trade with fake money in real time, and when you are ready, you run it live. Let me walk through what it actually does, because the features are the spine of this course. It backtests. You give it a strategy and a time range, one command, and it simulates every trade it would have made and hands you a report. How many trades, what win rate, total return, maximum drawdown. This is how you avoid paying tuition to the market with real money. It optimizes parameters. Strategies have knobs you can turn. What RSI threshold triggers a buy? What moving average period? Where do you set the stop loss? Instead of guessing, Freqtrade can test hundreds or thousands of combinations and tell you which ones held up. I'll warn you now though, this is also the easiest way to overfit, so we'll talk about how to use it responsibly. It paper trades. This is the feature I love. You run the bot against live market data. It executes your real logic in real time, but no actual orders go to the exchange. It is a dress rehearsal with zero financial risk. You find out whether your backtest results hold up when the data is live and unpredictable. It trades for real when you are ready. Same bot, real orders, real stop losses, running around the clock, and it gives you tools to see what is happening. Charts with your buy and sell points marked, so you can look at a strategy visually instead of just reading numbers. It supports the major exchanges: Binance, OKX, Bybit, Kraken, and others, spot and futures. You switch between them by changing one line in a config file. Now, is Freqtrade the only option? There are paid services that are easier to click around, and you could always write your own bot from scratch. Freqtrade sits in a particular sweet spot. It is free and open source, so there are no subscription fees, and you can read every line of what is handling your money. It is powerful, because backtesting, optimization, and live trading are all built in. It has an active community, so when you get stuck, someone has usually been stuck there before you. The cost of all that is that it requires some comfort with Python and the command line, and there is a learning curve. That curve is what the rest of this course is for. One more thing on Freqtrade, and it is important to be clear about what it can't do. It cannot predict future prices. There is no crystal ball. It cannot guarantee profits. Every strategy carries risk. It is not completely hands-off. You have to monitor and maintain it. It will not invent a perfect strategy for you. That is your job. And it will not save you from a genuine black swan. It is a tool. A good one, but a tool. Is this for you, and what to expect before we wrap up? Let me be straight with you about who this is for and who it isn't. Quant trading suits people who actually like digging into data and finding statistical patterns, who can read at least a little code and are willing to modify it, who have the patience to let a strategy prove itself over months, and who have the discipline to follow a plan they wrote down. It also requires money you can afford to lose. If any of those is missing, that is fine, but be honest with yourself about which. It is a bad fit for people chasing the thrill of gambling, for anyone who panics at seeing red, for anyone who needs profits this week, and especially for anyone planning to trade with borrowed money or money they need for rent. If that is you, please don't. The market will take it. So what should you actually expect from this course? It is a full series, around 30 lessons, and it is structured to take you from zero to a strategy you've tested, paper traded, and cautiously run with small real capital. We'll cover environment setup, the core concepts, downloading data, running your first backtest, reading the results, comparing strategies, optimizing parameters without fooling yourself, setting up real-time signals and Telegram alerts, visualizing what your bot is doing, going through a pre-live checklist, and finally live trading with small amounts. There is also advanced material on building custom strategies, multi-timeframe analysis, machine learning, and futures. You don't need to be a programmer. You don't need advanced math. You do need to be able to use a command line and read some English. And it helps a lot if you've traded on an exchange before. So the vocabulary isn't completely new. Two things I want you to take from this first lesson, more than any feature or definition. First, the single biggest advantage of quant trading is that it takes your emotions out of the moment of decision. That is it. Everything else is secondary. Second, and I mean this literally, start with paper trading, and only ever risk money you can afford to lose. The people who get hurt in this game are the ones who skip straight to real money with a strategy they barely tested. Don't be that person. We have a whole path designed, so that by the time you put real capital in, you've earned the right to be confident. That is lesson 1. In the next one, we'll actually install Freqtrade and get your environment set up, so you can stop hearing about it and start using it.